Ladies and gentlemen, if you're holding silver today, listen closely. We are standing on the brink of one of the most dramatic upward explosions this market has ever seen. I'm talking about a move so profound that when it happens, your silver holding won't just gain value, it could become almost priceless. When you step back and strip away the daily noise, the headlines, the emotional reactions of the crowd, something very clear begins to emerge. Silver is not expensive, it is historically suppressed. And that distinction matters more today than at any other point in recent decades. Markets don't move randomly. They rotate, they compress, they build pressure, and then they release. Silver has been doing exactly that, quietly, patiently, and methodically, while most investors have been distracted elsewhere. Historically, silver has never stayed undervalued forever. Every major cycle tells the same story. There is a long period where silver lags, where it feels frustrating, where it underperforms relative to expectations. That phase is not failure, it is preparation. Capital doesn't rush into silver early. It waits until disbelief turns into curiosity, curiosity into urgency, into panic buying. We are still in that early disbelief stage, and that's exactly why the opportunity exists. If you look at the long-term relationship between silver and gold, the imbalance is impossible to ignore. The ratio has stretched far beyond what history considers normal. Every time that happens, silver eventually plays catch-up, and when it doesn't move slowly. It reprice. That repricing is not linear, it's explosive. Investors who understand market structure recognize this as a classic compression phase, where value builds beneath the surface while price appears stagnant. What makes this cycle even more compelling is that silver is not just a monetary metal, it's an industrial necessity. Unlike gold, silver is consumed. It disappears into technology, energy systems, electronics, and infrastructure that creates a silent drain on supply that most people overlook. Above ground silver inventories are not infinite, and they are certainly not growing at the pace global demand requires. Over time, that imbalance forces a reset. Markets cannot ignore physical reality forever. Now, layer that supply dynamic on top of silver's historical undervaluation, and you start to see why the setup is so powerful. Silver is priced as if demand is optional, but it isn't. It's priced as if abundance is guaranteed, but it's not. The market has been conditioned to see silver as secondary, volatile, and speculative. That perception is precisely what keeps prices suppressed until the moment it snaps from a cycle perspective. Silver has spent years moving sideways, carving out a broad base. These are not weak structures, they are foundations. Long consolidation phases tend to precede the strongest advances because they shake out weak hands and transfer ownership to patient capital. That process doesn't make headlines, but it creates the fuel for future moves. When silver finally breaks free from that structure, the move won't ask for permission. What most people fail to understand is that undervalue does not mean cheap for a week or a month. It means a mispriced relative to time, demand, and historical norms. A silver has been mispriced for years. That doesn't invalidate the thesis, it strengthens it. The longer a market stays compressed, the more violent the expansion tends to be. That's not opinion. That's market behavior repeated over decades. And here's the critical point. By the time silver feels obvious, the opportunity is already gone. The biggest gains in any cycle come from recognizing value before the crowd emotionally catches on. Once silver starts making headlines, once everyone suddenly understands its importance, prices will already be dramatically higher. That's how every major revaluation unfolds. So when you hear the phrase, almost priceless, don't interpret it emotionally. Interpret it structurally. It doesn't mean silver becomes untouchable. It means its purchasing power expands dramatically relative to today. It means the market is forced to acknowledge what it ignored for years. It means a quiet asset becomes a strategic one overnight. Silver isn't waiting for permission from the market. It's waiting for pressure to reach a breaking point. And history shows us that when that point arrives, silver doesn't whisper. It roars. When you analyze silver purely through the lens of price action and market structure, a very different story emerges than what most people see on the surface. This is not a market drifting aimlessly or struggling to find direction. This is a market that has been compressing, tightening, and coiling itself into a structure that historically precedes powerful sustained moves. Technical analysis isn't about prediction, it's about probability. And right now the probabilities are shifting in a very meaningful way. For a long time, silver has traded within a wide range, frustrating both bulls and bears. That kind of behavior is often misunderstood as weakness. In reality, it's one of the strongest conditions a market can develop. Sideways price action over an extended period builds what technicians call a base. A base represents agreement between buyers and sellers. And when that agreement finally breaks, price doesn't drift out of the range, it escapes it. What's important to understand is how that base has been forming. Silver hasn't been collapsing into lower lows. It hasn't shown structural breakdowns. Instead, it's been respecting long-term support zones again. And every time price dips into those areas, buyers quietly step in. That's accumulation. It's not emotional buying. It's strategic positioning. Smart money doesn't chase price. It builds positions when volatility is low and sentiment is indifferent. At the same time, overhead resistance has been tested repeatedly. Each test matters. Resistance doesn't weaken in one dramatic moment, it erodes. Every push into the upper boundary of a range absorbs supply. Sellers who wanted out have already exited. That leaves fewer obstacles when the breakout finally occurs. Technically, this is pressure building inside a tightening coil, and markets cannot remain compressed indefinitely. Momentum indicators are also telling a very clear story. Instead of showing exhaustion, they've been resetting while price holds firm. That's a sign of strength. Strong markets digest gains by moving sideways, not by collapsing. When momentum resets without price damage, it creates the conditions for the next leg higher. This pattern repeats across all major asset classes before large directional moves. Volume behavior reinforces this setup. During pullbacks, volume has been muted. During advances, participation increases. That asymmetry matters. It suggests selling pressure is drying up while demand becomes more aggressive on strength. This is how trends are born quietly without excitement. While most market participants are still waiting for confirmation, another key technical element is time. Silver has spent years working through this range. Time is not neutral in markets. The longer price moves sideways, the more energy is stored. Think of it like a spring being compressed. Short consolidations produce modest move. Long consolidations produce outsized ones. From a technical standpoint, silver is sitting on a multi-year structure that aligns with some of the largest historical advance answers the metal has ever produced. Moving averages are beginning to flatten and align. Another subtle but critical signal. When long-term averages stop declining and start moving sideways, signals a transition phase. That transition is from distribution to accumulation and eventually to expansion. Once price decisively clears those averages and they begin turning upward, trend-following capital enters the market. That's when moves accelerate rapidly. Breakouts don't announce themselves with certainty beforehand. They occur when skepticism is highest and participation is lowest. That's exactly the environment silver is in now. Many traders are waiting for a clear signal. By the time it appears obvious, price will already be significantly higher. Technical breakouts reward preparation, not reaction. Volatility contraction is another piece of the puzzle. Silver's price swings have narrowed, creating a calm surface that hides growing internal pressure. Historically, periods of low volatility are followed by sharp expansions. Volatility is cyclical, just like price. When it expands quickly and directionally from a technical perspective. Nothing about silver suggests weakness. On the contrary, the structure suggests readiness. The market is balanced on a threshold where even a modest catalyst can trigger a powerful move. Once price escapes the range that is contained for years, algorithms, trend followers, and institutional capital will all respond at the same time. This is how technical breakouts unfold. They don't creep higher, they surge. And silver, by every measurable technical metric, is approaching the point where hesitation turns into acceleration. When you zoom out and look at the global landscape, it becomes clear that silver is no longer just responding to its own internal dynamics. It's being pulled into a much larger macroeconomic shift. This is where markets transition from being driven by speculation to being driven by necessity. Capital moves differently when confidence erodes, and right now, confidence in traditional systems is quietly but steadily weakening. For years, markets have relied on easy liquidity, predictable policy responses, and the assumption that central authorities can always step in and stabilize conditions. That belief has shaped investor behavior across equities, bonds, and currencies. But cycles change, debt levels expand, policy tools lose effectiveness, and volatility begins to leak into areas that were once considered stable. When that happens, capital starts searching for assets that sit outside the financial system rather than inside it. This is where silver enters the picture in a much more serious way. Unlike paper assets, silver carries no counterparty risk. It doesn't rely on earnings, projections, balance sheets, or policy credibility. Its value isn't someone else's liability. In periods where trust becomes fragile, that characteristic becomes extremely important. Investors may not rush into silver immediately, but they eventually rotate toward it. As uncertainty compounds, currency pressure is another major force that cannot be ignored. Around the world, currencies are being diluted not suddenly, but persistently. Purchasing power erosion doesn't happen in a single dramatic event. It unfolds slowly until people finally recognize historically precious metals act as a pressure valve for that realization. Silver in particular tends to lag early and then outperform once currency stress becomes more visible. What makes the cycle unique is that silver is being pulled from two directions at once. On one side, you have monetary demand investors seeking protection from systemic risk. On the other, you have structural industrial demand that doesn't disappear during economic slowdown. Energy transition technologies, electronics, and infrastructure projects require silver regardless of sentiment. That dual demand creates a foundation that is far stronger than most people appreciate. At the same time, global markets are becoming increasingly sensitive to shocks. Supply chains are less efficient, geopolitical tensions are persistent, and economic data swings are more pronounced. These conditions increase volatility across asset classes. In that environment, diversification isn't optional, it's essential. Silver has historically functioned as a volatility hedge during periods when correlations between traditional assets break down. Interest rate dynamics also play a role here. Whether rates are rising, falling, or stuck when uncertainty, the side effects matter more than the direction. Higher rates strain debt-heavy systems. Lower rates signal economic stress. Either way, the result is increased instability. Silver doesn't need a perfect rate environment. It benefits from the consequences of policy extremes. Another overlooked macro factor is confidence fatigue. Investors have been conditioned to believe that every drawdown is temporary and every correction is a buying opportunity in the same assets. Over time, that mindset weakens when recoveries take longer and volatility becomes more aggressive. Capital begins to rotate not because of fear, but because of realism. That rotation doesn't happen overnight. It builds quietly, then accelerates. Silver also benefits from being underestimated at the macro level. Large institutions often treat it as a secondary asset, allocating minimal exposure that creates an imbalance. When allocations shift even slightly, the impact on price can be dramatic because the market is relatively small. It doesn't take massive inflows to move silver, it takes recognition. Macro-driven moves are rarely smooth, they unfold in waves. Silver tends to surge, consolidate, and then surge again as new participants enter the market at different stages. This creates volatility, but it also creates opportunity. Those who understand the macro backdrop aren't shaken by short-term swings. They recognize them as part of a larger repricing process. The key takeaway is this: silver is not being lifted by hype or speculation. It's being pulled upward by structural forces that are slow-moving but powerful. Currency stress, systemic risk, industrial necessity, and confidence erosion are not short-term events. They are long-cycle pressures. When those pressures align, markets don't adjust politely. They revalue aggressively. This is how silver transitions from being ignored to being essential. Not because the story changes overnight, but because the world around it does. And when that shift becomes undeniable, silver won't need justification. It will simply be repriced to reflect reality. One of the biggest misconceptions about silver is that its volatility is a weakness. In reality, volatility is not the enemy of opportunity. It is the mechanism through which opportunity is created. Markets that move slowly and predictably rarely deliver outsized gains. It's the assets that swing, compress, surge, and reset that offer asymmetric potential. Silver has always belonged to that category, and that characteristic is exactly what positions it for extraordinary moves when conditions align. Volatility in silver is not random chaos. It follows cycles just like price. Periods of sharp movement are typically followed by long stretches of consolidation. Those consolidations are not signs of exhaustion. They are periods where the market digests prior moves and transfers ownership from reactive traders to patient participants. Each cycle resets sentiment, shakes out leverage, and prepares the market for the next expansion phase. What makes silver's volatility especially powerful is how quickly it can shift from quiet to explosive. Unlike larger, deeper markets, silver doesn't require massive capital flows to move significantly. When demand increases even modestly, price responds aggressively. That sensitivity is often uncomfortable, but it's also what creates the potential for rapid repricing when momentum builds. Most investors experience volatility emotionally rather than analytically. They see sharp pullbacks as danger and sudden rallies as risk. That perspective causes them to exit positions at precisely the wrong moments. Experienced market participants understand that volatility is information. It reveals where pressure is building and where supply is failing. In silver, volatility has repeatedly marked the transition from accumulation to expansion. Historically, silver's most powerful advances have come after long periods of frustration. Price chops sideways, confidence fades, and participation drops. That environment feels unproductive, but it's essential. It reduces speculative excess and sets the stage for sustainable advances. When silver finally breaks out of those conditions, volatility expands upward, not downward. Another important aspect of volatility is its relationship with timing. Silver rarely offers long windows of opportunity once it starts moving. The sharpest gains tend to occur in relatively short bursts. Those who are not already positioned often hesitate, waiting for pullbacks that never materialize. Volatility compresses time. Decisions that could be made calmly during consolidation must be made quickly once expansion begins. This is why patience and preparedness matter more than prediction. You don't need to forecast the exact moment volatility will expand. You need to recognize when the conditions are in place. Silver's extended periods of low volatility are signals, not warnings. They indicate that the market is storing energy. Historically, those signals have preceded some of the most dramatic moves in the metal's history. Volatility also plays a psychological role in repricing. Sharp moves attract attention and they force reassessment. As silver accelerates, it pulls in new participants who previously ignored it. That influx fuels further movement, creating a feedback loop. Volatility becomes self-reinforcing not because of speculation, but because awareness is expanding. Risk management is often misunderstood in volatile markets. Avoiding volatility entirely can be more dangerous than engaging with it strategically. Silver rewards those who size positions appropriately, maintain conviction through noise, and focus on structure rather than headlines. Volatility doesn't eliminate risk. It redistributes it from the prepared to the unprepared. Another overlooked point is that volatility often expands when liquidity thins. In silver, available supply is not endlessly elastic. When demand rises and liquidity tightens, price gaps can occur. Those gaps are technical anomalies. They are expressions of imbalance. Markets move fastest when they are forced to reconcile sudden mismatches between buyers and sellers. In the broader context, volatility is what transforms silver from a passive holding into an active driver of portfolio performance. It's the reason silver can lag for years and then outperform dramatically in a single cycle. That characteristic frustrates short-term thinking, but rewards those who understand long-term dynamics. Silver's volatility is not something to fear, it's something to respect. It is the engine behind its most significant revaluations. When volatility returns in force, it won't be subtle and it won't wait for consensus. It will move first and explain later. And those who understand its role will recognize it not as danger, but as confirmation that a powerful phase of the cycle has begun. So the real question isn't whether silver will move. The question is whether you'll be positioned before it does. Markets don't reward comfort and they don't wait for consensus. They move when pressure becomes impossible to ignore. Silver has spent years building that pressure, and history shows that when it finally releases, the move is fast, powerful, and unforgiving to hesitation. This is not about hype. It's about structure cycles and reality catching up with price. When silver transitions from being overlooked to being essential, the reevaluation won't ask for permission. It will simply happen. Those who understood the setup early won't be chasing headlines later. They'll already be standing on the right side of the move. Stay focused, stay disciplined, and most importantly, don't confuse silence with weakness.